Today, we will learn one of the most widely used methods of relative valuation, the price to earnings or the PE multiple method. We will cover the key aspects on PE, like what PE is, how to calculate it, where to use it, and key factors influencing PE. We will also learn how to assign a right PE multiple. PE ratio is price multiple or earnings multiple. It takes into account the full year earnings per share or EPS of a company. PE reflects number of dollars investors are willing to pay for each dollar of a company's earnings. It is calculated as a ratio of the current market price of a share to the earnings per share of the company. Simply put, PE ratio of 15x implies that for each $1 of earning, the investor has paid $15. Hence, it will take 15 years of earnings for the investor to recover the price paid. A higher than average PE either indicates market expectation of higher earnings in future or investors' willingness to pay premium for the low riskiness of the company's earnings. On the basis of which share price is used, current or average, and which EPS is used, current, trailing 12-month or forecasted, we may have different types of PE multiple. Please see this example carefully. While current market price divided by trailing 12-month earnings gives trailing PE, the same divided by forward EPS gives 1-year forward PE. Fundamental drivers for PE are 1. Growth rate G, for free cash flows of company. 2. Riskiness measured by discount rate R. And 3. Free cash flows available to shareholders. The relationship between these three key drivers for PE are derived in this slide, using the dividend discount model. Now, as second part of this session, we will try to understand different types of PE, and how to calculate them. There are 4 types of PE which are used in different scenarios. 1. Trailing 12 months or TTM PE. 2. Forward PE. 3. Relative PE. And 4. Average PE. Trailing PE is considered to be more accurate, as it is based on actual earnings. This is used when a company is expected to deliver annual earnings in line with historical growth. Forward PE indicates the multiple at which share price would trade in future. Forward PE of 18x means that for every $1 of future EPS, as of now investors are willing to pay $18. If a company's earnings are expected to grow, then forward PE would be lower than the current PE as it is inversely related to earnings. Suppose the trailing PE for a share is 20x and the forward PE of the same is now 10x. The right conclusion would be that either the price has corrected or expectation of earning growth is higher than before. We also need to answer the following questions around market conditions and earnings growth, to understand if a stock is undervalued or overvalued. The relative PE compares a company's price to earnings with the market's price to earnings ratio. Over the same period, a company with better earnings growth prospects than the market, or with lower risk, or both, would have a higher PE ratio than the market. Average PE is the average of the high and low price to earnings ratios for a given year. This PE is used to eliminate the effect of volatile movements in share price. Now, as third part of this session, let us try to understand how we can value a stock, using price to earnings multiple. The value of common share of the company is calculated by multiplying earnings per share with the applied price to earnings multiple. The art is in applying the right PE multiple. To apply right PE multiple, compare PE of the company with 1, its historical PE, 2, other companies within the sector, and 3, the market multiple. Also check economic conditions. Let's learn how to use a company's historical PE for making a valuation call on its share price. The tools commonly used for this are 1. PE band chart. 2. PE ratio graph. We use PE graph to understand trends. See Domino's PE chart for 7 years. the average PE plus or minus 1 standard deviations is the range that PE ratios will fall 95% of the time. Domino's has traded within the range formed by the upper and the lower band. Yet, as for quite long, 2 years, it has stayed above the upper band. We should investigate further. When we use PE graph for the last 4 years, we observe that Domino's is now trading below the upper band, and whenever it has crossed the upper band, correction took place. In the second tool, the PE band chart, the upper band reflects the historical maximum price of the stock if the stock would have traded at its maximum PE. Likewise, the average and the lower band reflect the historical maximum price of the stock, if the stock would have traded at its average and minimum PE respectively. In this Domino's chart, the price is near the maximum PE band line, implying that the stock is trading near its maximum PE and may be overvalued. In positive operating environment, stock price between the average and minimum PE band lines might suggest a good buying opportunity. For effectively using PE of comparable companies in the sector, we need to analyze company-specific factors that might lead to a premium or discount to the average industry PE. Here is a comparable companies or peers multiple table that is used to value a company. It lists all relevant industry competitors and important financial and valuation parameters. Comparable companies should be of similar size of operations, as measured by revenue, and should have exposure to similar riskiness and growth prospects, that is, geographic markets. We need to remove outliers from the list as well, for example, removing companies with PE of 63.3x and of 5.85x. The average PE of sector comes down from 23x to 17.5x. With implications for valuation. Once we remove the outliers, the target price comes down from $61.70 to $47.70 for Nuco. Since a company's earnings is linked to economy and its share price is influenced by general market sentiments, investigation into PE relative to that of wider market is important. Domino's shares have historically traded at a premium to the market PE for long. The key reasons for this premium may include higher earnings growth or lower riskiness. As you can see, Domino's EPS has grown relatively at a higher pace since Q3 2011, the time Domino's started trading at a premium PE compared to that of the S&P 500 PE. You can also see that volatility in Domino's earnings, as measured by the standard deviation in Domino's EPS, is low as compared to that in S&P 500 stocks. Summing up, for assigning PE, analyze 1. Historical PE range. 2. PE of comparable companies. 3. Relative PE with wider market. And check for future economy and market scenarios. We can't just take industry average PE, as companies can have different growth, returns, and capital structures. We need to examine these critical questions before assigning PE. Price-to-earnings multiple is not particularly useful for negative earnings companies, as the PE ratio becomes meaningless. PE is also limited if there is large contribution from non-operating earnings, and the treatment is not consistent across companies. See how presence of huge cash impacts PE calculation of a company, in this slide. Capital structure of a company also significantly influences PE. To avoid this pitfall, we use EV or enterprise value multiples that includes impact of both debt and equity. Please see some common terms here, for your ready references. As we have understood PE in detail, let's now put our learning to practical decision making. Please go through next few slides on Apple and Microsoft and decide which share to buy. Microsoft is trading at a premium to Apple on forward PE, as well as on trailing 12 months PE basis for the last 1 year. On this chart, you can also see the last 5 years forward PE for both the stocks. and the last 5 years trailing 12 months PE for both the stocks are on this chart. Here you see that in the last 1 year, whereas Microsoft has given nearly 12% return, Apple shares lost 23% of its value. In the last 5 years, both stocks have generated returns of 110%. Please carefully study the earnings per share, historical and forward, for both stocks. Now put your understanding to test, and dwell upon the following critical questions, to arrive at investment decision. Thanks for attending my session. Looking forward to discussing the next session.